Today, I'm going to walk you through a complete, rules-based delta-neutral ODT strategy. The idea is simple. Generate intraday option income by selling premium on same-day index options, while keeping your portfolio's delta tightly controlled around zero. Instead of trying to predict where the market will close, this approach focuses on three things: time decay, the typical overpricing of implied volatility, and strict risk management. Directional exposure is treated as something to be minimized and corrected, not something to bet on. At a high level, the objectives are to stay close to delta neutral, use only defined risk structures, keep everything intraday, and follow rule-based adjustments rather than emotional decision-making. Let's start with the core building blocks of the strategy. The primary structure is an at-the-money iron butterfly on a ODT index option. Like the SPX, you sell one at-the-money call and one at-the-money put, then buy an out-of-the-money call above and an out-of-the-money put below as wings. This creates a defined risk, short volatility position centered around the current price. At entry, this iron butterfly is close to delta neutral and has high positive theta. It's designed to collect intraday time decay while containing tail risk through the long wings. This becomes your base position for the day. The second structure is the iron condor. Instead of selling the exact at-the-money strikes, you sell an out-of-the-money call spread and an out-of-the-money put spread, both expiring the same day. The condor usually earns a smaller credit than the iron fly but offers a wider profit zone and lower gamma risk. You can use an iron condor instead of the iron butterfly or alongside it to diversify risk. When the market is choppy and you want a bit more breathing room around the underlying price, the condor can be a better fit. The third component of the strategy is a set of small SPX credit spreads used to tune your delta during the day. These are simple bear call spreads and bull put spreads. When your portfolio delta drifts to positive, meaning you've become too bullish, you add a small bear call spread. You short a call and long a higher strike call with the same expiration. This is a defined risk, negative delta, positive theta adjustment. It nudges your overall delta back down toward zero while still contributing to income. When your portfolio delta drifts to negative, meaning you're too bearish, you add a small bull put spread. You short a put and long a lower strike put with the same expiration. This is a defined risk, positive delta, positive theta adjustment. It pushes your delta back up toward neutral, again, while still generating time decay. A key design choice is that even the adjustments are credit spreads with positive theta. You're not adding pure hedges that bleed. You're using small, defined risk income trades to keep the book centered. All of this is managed around a predefined delta band. You start by defining a target delta band for the entire portfolio, often expressed in a SPY equivalent measure. For example, you might choose a band of roughly minus 0.2% to plus 0.2% in SPY adjusted delta. The exact numbers are less important than having a clear, consistent rule. If your portfolio delta moves above the upper band, you are too bullish. The rule is to add one or more small bear call spreads to push delta back down and remain inside the band. If your portfolio delta moves below the lower band, you are too bearish. The rule is to add one or more small bull put spreads to lift delta back up into the band. If your delta is inside the band, you don't touch the position. You simply allow time, decay, and intraday price action to work. Over the course of the day, these small, rule-based adjustments help keep the portfolio centered around neutral while collecting premium. Now let's talk about risk management, because delta neutral does not mean risk-free. First, there is a daily loss limit. Before trading begins, you define a maximum loss as a percentage of account equity or a fixed dollar amount. If realized losses on open positions reach that number, you close the book and stop trading for the day. No exception. Second, each iron fly or iron condor has its own per-trade stop. A common rule is to cap the loss at roughly 1 to 2 times the initial credit received. If a structure hits that threshold, you close it. You don't let a single position spiral out of control. Third, there's an event filter. You reduce size or avoid trading entirely around major economic releases like FOMC announcements, CPI, and non-farm payrolls, where intraday volatility can become extreme and unpredictable. Finally, position sizing stays small and consistent. You use only a modest fraction of total account value per day so that any single session and any single drawdown has limited impact. Putting this together, here's how a typical trading day looks for this delta neutral ODTE strategy. Before the market opens, you review the economic calendar, the volatility environment using measures like VIX1D, and any overnight news that might affect intraday behavior. You note whether today is a normal session or a high-risk event day. After the open, you wait. You give the first part of the session time to stabilize. This helps spreads tighten and price action become more orderly. You don't rush into ODTE positions in the opening volatility spike. Once the market has calmed down, you enter your base position, one or more defined risk iron butterflies or iron condors centered near the current index price. At this point, you check the portfolio delta and confirm it is within your target band. As the day unfolds, you monitor both price action and your aggregate Greeks. If the index drifts and your portfolio delta moves outside the band, you respond with a small, predefined adjustment. A bear call spread if you're too bullish, a bull put spread if you're too bearish. If a specific structure reaches its maximum loss threshold, you close it. If the overall portfolio hits the daily loss limit, you flatten everything and stop. As long as your portfolio delta stays inside the defined limits, avoid adjustments and allow the position to collect theta decay. By the end of the session, all trades are either closed or converted to cash. There is no overnight risk. You record your results, note what worked and what didn't, and prepare to repeat the process on the next valid trading day. This strategy is suitable for traders who value rules and structure over gut feeling, who are comfortable monitoring the market during the day, and who prefer defined risk, premium selling approaches. It's not a set-and-forget system, and it's not a guarantee of profit. Even delta-neutral strategies will experience drawdowns and occasional tail risk events. But with clear objectives, well-chosen structures, a tight delta band, and strict risk controls. A delta-neutral ODTE framework like this turns same-day options from a directional gamble into a systematic, intraday income engine. That's the core idea behind the delta-neutral ODTE strategy. Sell time, control delta, limit risk, and let a disciplined process do the heavy lifting. I hope this gives you a solid foundation for exploring this fascinating approach. Thanks for watching, and don't forget to like and subscribe for more content like this.